What is going on, everybody, and welcome to another weekly update. What I like to do in these videos is provide you some upcoming earnings events in the upcoming week to get you prepared for what could potentially happen. But not only do I provide weekly updates, I do provide daily updates as well to get you prepared for the day in the week ahead in this phenomenal market in which we are currently in. Now, what I like to typically do is give you a state of the market. But before we do, as every weekly update, we like to go ahead and throw this up here, give you kind of some ideas. What we're looking at this week. It's a very basic week. What really matters is your core CPI that comes out on Wednesday. Now, what has gone on during this past week? We had some very interesting news. We had the non-farms, which was extremely strong. The market has been doing well. We've got a lot of very contradicting information. The week started out first off with essentially China and Pelosi. Pelosi flying to China and that whole threat that we could potentially be getting into a war with China. And then that was diluted midway through the week, and then it's been pretty quiet since. That's not saying that China can't do anything. They don't directly come out with specifics as far as any kind of like action taken. They're more behind the scenes kind of work. So we'll have to see what comes of that. That is something that is now in the back pocket that could show its nasty face at any point. So you have to be well aware of that. And I do apologize if you can hear the thunderstorms in the back, but there are quite a bit of thunderstorms. So with that being said, and then later on in the week, we had the non-farms, which came in at some ridiculously high expectations, or the expectations came out and then we just blew that out of the water. We pretty much almost doubled what our expectations were for employment. Now, to give you some story and some thesis building here on what I'm thinking. Now, I've said up to this point, I'm a permeable, and that's just the way I've always been. The market's designed to go up. But there's a lot of red flags that I keep talking about, and a lot of people are scratching their head, why do we keep going up? And a lot of times the market will do whatever it wants, and it won't make sense at all. This is, again, one of those times. But you still have to be mindful that there is some real dangers that could potentially happen here. Now, coming in, you have, again, great job numbers. The administration has talked about that. Yes, that's great. And they keep saying we're not in a recession. We're not in a recession. How could you have a recession if you have great job numbers? But you have to also know that numbers are fudged a lot. And there has also been some, the job losses have been continuing to grow, yet the record number of jobs, the non-farm that came out is just absurd. So there's something that's not adding up. You got the yield curve, which is still out of balance. It's telling you that we are in a recession. So it's not saying we can't come out of a recession. I'm not saying that, but you have to just be very careful. And what really matters is this core CPI. And we've had the Fed over multiple days warning that inflation is continuing to run, that will continue to front run inflation. They keep headlining this, so this should not be new news if we come over 9.1. This is why I have the 9.1. This is what we essentially tracked on the last one. This is headline inflation, understanding food and energy continue to rise. Yes, you're seeing other inflation come down, used cars and everything essentially kind of led the pack in the beginning of spring. And then at that point, it switched over to just food and energy at that point. And it's going to continue to be an issue going forward, especially with the whole Russia-Ukraine incident and then potentially with China. So that could put more strain on the supply. So just be mindful of that. And something I said, you do need to, I think if you're not looking 5-10 years down the road, you should be taking profits along the way. Again, not financial advice, but in the market like this, you don't know what's going to happen. And these massive pumps that we got, they could dump all the way back down on one piece of information. And so going in, the core CPI is going to really matter. I believe their expectations for this core CPI is 8.8. So it's even above last expectations, yet every economist missed on the last report. So that's something to keep in mind. So again, if we come in at 9.1, somehow I think we'll be bullish. Even though it's really bad, because that just means the Fed with a strong job market, supposedly, and inflation can continue to run, we'll start seeing 75-point basis, 100-point basis moves easy. Then at that point, it'd be normal. And then maybe the market would just run, even though that is going to cause a lot more problems than we'll see. But it's going to take time for that to play out. Again, a highly very are hyper focused on Q3 in this report. And if we come in at 50, 75, 100-point basis move again, I think it's going to hurt, right? This is why the stock splits have happened. This is why the layoffs are just starting to happen. It's just the beginning, in my opinion. As I'm saying, the market can't rip up from here. It sure can. It doesn't need anything specific, but we go into a recession. We have to understand that we've been slowly conditioning everybody to believe that with the current situation that we're in is okay, but it's not. It's really bad. That's the way the market works. The market gets conditioned that it's okay because it sees it multiple times a day, and then they're like, oh, well, we're just in a recession. It's okay. But if we don't get a grasp on it, we're going to go into hyperinflation. And that's the issue we are potentially dealing with here. So with all that being said, Wednesday is a huge day. That report will come out at 8:30 a.m. Eastern Standard Time, and that will give us the updates on what's going on. Again, the Fed meeting isn't until September 20th and 21st, so we got a long ways. So if we're going to rally at all, now is the time to do it. After this report, we may sell off for the report and then turn around and try to run and then start selling off again. Going into the Fed. So, and then earnings this week. We got PLTR and UPST. Those are both on Monday. We are pretty much out of the bulk of the really good earnings. So now we're kind of just on the tail end of that. So you're starting to see some stuff sell off, which I'll kind of get into. Tesla started to sell off pretty heavy on Friday. Looking for that to continue. Once you get out of earnings cycles, these things will sell off in preparation for the next cycle. So it's more so just waiting for it to find a bottom and kind of consolidate, and that's when you kind of buy in. Again, these cycles play over and over and over, even no matter what's going on. They might sell a little bit more, but these cycles are always the same. About from anywhere from 3, 4, 5 weeks out after an earnings, typically that stock will sell off pretty heavy. It really depends on the state of the market, and then go from there. And then watch list. Again, I'm just keeping the basics on here again because it's going to change very dramatically on what happens during the week. Even the general index has a 84 point move. Tesla 55, BA 7, JPM 4. I'm really watching tech this week because if for some reason that inflation is extremely high, that means interest rates are going to go through the roof, and then tech is going to take a massive haircut. And they've already pushed, and they've been one of the front runners coming into the earnings. They normally typically are, but they really got a good run on this last earnings. So you have to be mindful of that moving forward. So that's what we're up to. So as far as technical wise, we're hitting a very strong resistance at this 41.78. If we can break above this, we could potentially break out. There is this very strong trend line as well on the weekly that we need to break out over. So unless we really get up to the 42.65, I don't think we're really safe yet. If we break back down below the 40.80, that could be an issue, as we could be revisiting lower levels from that point. Though if we do break, you're going to be doing a lot of rattling on the way down unless there's some really heavy news. Again, if we come over 9.1, that's really just going to be an issue. That's going to be you're going to start striking fear if we come in at 9.1, over 9.1. And so if that does happen, I could see us just start melting way down here past this again. We've been as far as the levels, because I've been talking about 50 point, 75 point. I mean, the market's kind of pricing in, sitting at a 75 point basis, or 50 point basis move, roughly around this 40.75. So it's been kind of hovering around here. Potentially, I think if the inflation is down down from anywhere from a 9.1, which again is still really bad. Even if it's like a 9, the market may rip off of that, which is still really bad because it just means the Fed, again, with the strong job payroll, non-farm payrolls, and inflation being so high, they're going to just continue to pump these rate increases out. That just means they'll prolong it, so they'll have a lot more 75-point basis moves, which would drive us in, because then at some point you're going to realize that it's going to catch up, and then it's going to be so bad that you're going to have to really dial back for it to like slow down, right? And so I think we were just still in the beginning of everything. We're just slowly seeing this thing play out. So that's my concern, is again the front running and understanding what's going on there. So those are the technical levels. I'll look at Bitcoin real quick. Again, it's going to follow the market, so don't want to get into this too much. I think Bitcoin again can still run up to 28, and then I think at that point it can still nosedive down. So just be mindful of that. Again, it doesn't have to happen. It's already sold off a lot. So we can get into cycles. What kind of winner do we have going forward with crypto? I don't think it's going to be the same as before. I think there's too much mass adoption for it to go back. I think there's a point in time before mass adoption happens where you're going to get more volatility, and you've seen that before. And so now it's starting to become more of the norm. So you're not going to get swings all the way down to 5K. Not saying it can't do that, but I think at this point you're not going to see that. I could still see 10 potentially, but we just have to see. We have to wait and see. Again, anything is possible, so that's why you can't buy one side or the other too heavily. The dollar is still sitting at 106. The dollar is still extremely strong. Oil has actually come down below $100 a barrel, which is good to see. But we have to see moving forward. Again, if anything does happen with Europe, again, we've tapped reserves. You have to understand that it's going to give us relief, but for how long? That we tap reserves in hopes it would be for a little bit longer. But you have to understand that this is, you're walking on eggshells with this. Something else needs to come of it, or else this is going to shoot right back up. So with that being said, because I know I think they were first initially given estimates about oil, I think it's $65 a barrel going into June, July. They were talking about it coming way down about there. So could potentially still sell. We'll see. I'm not a big oil guy, but I do have some insight into some oil reserves and stuff, thanks to some friends that I have that work in the oil industry. So with that being said, see, BA is the other one I got. So let's look at some value. Some value is interesting. It looks strong, right? You want to see strength across all industries, and so that's what we're kind of looking for here. BA could potentially keep running here. Again, it looks just like the market. A lot of stuff looks just like the market. Again, if the interest rates are high, the banks could push up really well, so could value, and you'll see tech sell off. That's kind of what I'm thinking is going to happen this week. So you might get a nice push out of value and the financial industry next week. So that's what I'm really watching there. And then we have JPM. So let's look at the banks. Banks have really been chopping, although we had a really nice candle coming into, again, this purely based off a jobs report. Again, if there's rate increases and stuff like that, that's going to help the banks. But in turn, it also wrecks tech. So we could see if this does break out here. Let me extend this over to the right. If this does break out on Monday, you could get a nice run of the banks. It's been consolidating for a very long time. The last thing you want is this thing to break below this. We'll give it 114. If it breaks back below this and starts selling off more, it could happen. Again, we've only hit roughly close to a 25% correction on the full year. If we did a recession, it's not saying every recession hits. Normally the average is 41%. We haven't even come close to that, but it's not saying we have to hit it, right? It's just an average. This could be one of the shorter term ones. I think this would be a shorter term one just because of a lot of things that are set up, but you're seeing a lot of other different things. Housing, if you want to talk about the housing sector, it's really hard just because of the fact that anything that happens in the housing sector, even if that bubble bursts, it's very slow. It's nothing fast. In the stock market is fast to react to news and pricing in stuff. But you have to understand when you price in stuff as well, like the market will hit where it thinks it's priced in, but then as soon as it hits that, it continues to start pushing up. And so if you want to say priced in, it doesn't mean say this is where it's priced in at. This is just an example. I'm not really using JPM, but say it's priced in at 107, right? That whatever the rate increase is, they priced in 107, so it hit 107. And then the market seems to be normal. There's no new news. So this JPM pushes all the way up to 128. And then it comes out that, hey, yeah, so we were wrong. So it's a 100-point basis move. And then this thing will drop all the way back down to where it was, or close to where it was priced in. Yes, it was priced in, but it doesn't mean the market's not going to try to correct right back down to where it is. And that's why I have the things, the levels marked out on the SPX, the general index, so that way you can kind of see that. Again, this is my thesis, this is what I work with. You can come up with your own thesis, and I highly suggest that you do that. I highly suggest you do follow other people. I highly suggest that you come up with your own thoughts and ideas, and just use mine as perhaps a jumping point and perhaps to bounce ideas off of. But nonetheless, I don't think anybody is wrong in however they trade. I think you should always challenge the way people trade. It's just my opinion. Take it for what it's worth. But I always challenge you to think for yourself. So with that being said, that's pretty much what I got for this week. Again, the market is really just waiting to see what's happening, because that is really what's going to matter. That's what's really going to dictate. Institutions aren't going to jump in unless they know what's going on. And until they get at least that core CPI, we're going to get 2 core CPIs before we actually get the next Fed meeting, unless this one is so bad that they do an emergency rate raise, which could happen. But everything is very historic right now. This is all new, right? The environment's not the same. You can go back and look at history, whatever the case is. Everything that we're going through right now is all new. You can't compare it to history because it can change. One piece of data can change anything. One overnight session and China kicks some stuff off and the whole thing changes. Or, right, the Ukraine war stops. Everything goes back to normal and we go back to all-time highs. It's all a possibility. It's always 50-50. And this is why I say it depends where we land each and every day with the new information that we get. So if you made it this far, I appreciate you. Go ahead and drop a like button. Till next time, I'll see you guys later.